Welcome to this week's version of Nichols and Dimes, our weekly video series. The quote of the week this week actually comes from one of the more reputable investment managers of today's time. That's Jeremy Grantham. And I saw this quote recently and I thought it was very telling. Jeremy says, "I've been very clear about what I consider a definition of success. And that is only that sooner or later, you will have made money to have sidestepped the bubble phase." You will have made money to have sidestepped the bubble phase. Now, there's a couple interesting points that he makes here. Number one, to sidestep, meaning to avoid a big downtrend. So how do you avoid a big downtrend? You have to first identify you're in one. And number two, you have to have an investment strategy to do that. Now, the strategy could be in the form of traditional asset allocation. Maybe it's in the form of selling, raising cash, meaning selling for example, your equity or stocks. Maybe it's hedging using put options or even shorting, which is effectively betting that your stock will go down. So there's a multitude of ways to hedge, but again, you first have to identify that the trend is not is turning down, and number two, you have to have a strategy to protect your wealth. An interesting study has been done that I'd like to share it with you that looked at the historical returns of investing $10,000 in the S&P 500 index from 1970 to 2019. So what's interesting is if in these four scenarios, you invested in the S&P, again, from 1970, and if you invested at $10,000 and bought and hold, effectively just bought and hold, your $10,000 would turn into $1.53 million. If in that time frame you missed the 10 best and worst quarters, your $10,000 turned into about $2 million, about $1.9 million. If you missed in that same time frame the 10 best quarters, your $10,000 would turn into $287,000. But here's what's the most interesting statistic in this analysis is if that $10,000 was invested in 1970, over that 39-year period of time, actually it's 49-year period of time, if you missed the 10 worst quarters, your $10,000 would have turned into $10,487,000. Well, isn't that fascinating? So what is the takeaway from this analysis? That your ability to avoid losing big from a historical perspective will likely, if history is any guide, give you significantly more money down the road. So again, I'll say that again, your ability to mitigate losses and to identify when the trend turns south to effectively preserve your capital, presumably to save you money and a lot of stress, you will likely have a lot more money down the road. But it also presupposes that you have a proactive investment discipline to hedge when those market downturns occur. Now, there's multiple ways, as I said earlier, to do it. You could have traditional asset allocation, which and sometimes works, sometimes it doesn't. Think of the financial crisis in 2008. A moderate allocation fund was actually down around 28%. When the market was down 50, most people are still not willing to lose or be down 28%, especially if you are nearing or in retirement. So again, preservation is the key when you're, when you don't have a long time horizon. So again, at traditional asset allocation, or you can implement a hedging strategy, whether again, it's raising cash, maybe it's buying put options, maybe it's shorting. So here's the point. Number one, are we in a bubble phase right now? So there's many metrics that we look at that are very concerning, that are suggesting that the market is very likely near the end of the bull run. What metrics we look at, one of them is margin debt. Right now, there's some of the largest in totality, in aggregation, margin debt in history. And effectively, if you don't know, margin debt is basically borrowing against your portfolio to buy more shares. That is very concerning. Also, one thing that is very concerning is valuations. Recently, we've seen the electric vehicle space with companies like Lucid as an example, having ridiculous, in my opinion, over-the-top valuations, and these companies, or a company like this, for example, loses money. Now, I'm not picking on Lucid. They have fantastic technology, and I know there's a lot of efficiencies with their battery technology. Their car is beautiful. But when their valuation is more than most auto manufacturers combined, including GM, Ford, and many other very credible companies that have been around a long time and that are profitable, there are things that are concerning. Again, I'm just using them as an example. So again, look at the historical data and understand where you are in a market trend. Have a protection plan in place to identify if and when that plan or the trend turns down, your capital is protected. Again, according to the data based on from 1970, by avoiding the worst 10 quarters, you will likely have a lot more money down the road. Again, if you're nearing retirement, we think this is critically important. And number two is, if you are in retirement, you don't have a whole lot of time to make back what you lost. To that end, if you would like a second opinion on a portfolio or financial situation, just to get a second opinion on what we think about the markets, and again, how your portfolio would potentially compare if and when we have another big downturn, send me an email at cnichols@nicholswealth.com, or you can go on our website at nicholswealth.com to learn more about what we do. In the meantime, thank you again for watching. Have a good day.